All right, we'd like to welcome you to our February Farm Office Live. Maybe we should have been saying, take me down those slippery, icy roads in Northern Ohio today, Diane Shoemaker. Just would like to welcome you, everybody coming on to today's Farm Office Live. We have a great lineup of speakers as well as topics for this month's Farm Office Live, which includes a fertilizer price and update and rental update, a financial standards update. We're also going to take a peek at the Farm Office website today and then move into the Federal Farm Program update, as well as learn about the ARC PLC decision for the Farm Bill decision that's coming up here in the next couple of weeks for farmers. And then we're going to close today's Farm Office Live with a federal and state legislative update. I'd like to introduce to you our teaching team for today's webinar. First, Diane Shoemaker, OSU Extension Field Specialist for Dairy Production Economics. Barry Ward, the Director of the OSU Income Tax School and Leader for Production Business Management. Peggy Hall, who's the Director of the OSU Agriculture and Resource Law Program. Yours truly, David Marison, Agriculture and Natural Resource Extension Educator in Coshocton County. And joining us, we have to go 2 slides now. We have Chris Brunis is going to join us today, OSU Extension Educator and Associate Professor. Chris is located in Ross County. Then we have Robert Moore, our newest member of OSU Extension. Welcome back, attorney. And he's part of our OSU Agriculture and Resource Law Program. And Jeff Lewis, attorney and program coordinator in OSU Extension, is also he's going to share the website, but also Jeff is behind the scenes making sure everything flows into the chat box and the Q&A. Now, just as a reminder that the slides for today's program, as well as a recording, can be found at go.osu.edu/farm office live. Again, that web link is go.osu.edu/farm office live. Not only will today's program be found on that location, but you can go back and watch every Farm Office Live, clear back, I believe, to March 2020. So when we started these programs, when the coronavirus pandemic hit. So you can see those monthly webinars all the way back, as well as access those PowerPoints. Just a few housekeeping issues. We'll be dropping into the chat feature. We'll be dropping the links that you will need to access some of the website and the other things that each of the speakers will be talking about. So we ask you to use the Q&A feature that is found on your toolbar, the Zoom toolbar, to be able to ask those questions. And we welcome you to ask those questions as we move through today's program. We will either answer those live or we'll drop in our chat and our thoughts in that Q&A feature. Also, if you get into this weekend and you have a question that comes up, don't hesitate to drop an email to any of us to ask those, or if you just want to remember my email at marison.2@osu.edu. More than welcome to drop me that and I'll get it out to the team to answer those questions for you. And we do have a quick evaluation at the end of today's program. When you exit the Zoom webinar, it will take you to, and I see on my screen it says Barry, there's like a thing for your enterprise budget says showing up there. If you notice on that, it was kind of like a gremlin has shown up and says, hey, there is the evaluation. But we'd ask you to do an evaluation when you exit today's program. Take a couple minutes and just know that we do read those evaluations, and then that helps us plan the next Farm Office Live. So with that, I think, Barry, you're first up. And I think, Barry, you've been the hottest, as I said the other night, the hottest person on the Ag Policy and Outlook meetings around the state, because you have gotten to talk about fertilizer prices as well as cash rent updates. So that's what you're going to share with us today. So Barry, I'll turn it over to you.
Well, thanks, David. I'm not sure about the hottest person. The topic that's probably most concerning, maybe, and that's fertilizer. How's my volume? Is it okay?
Really good, really good.
Good.
Okay, great. Thanks. And welcome, everyone. It's good to have you with us here on a wintry Friday morning. And it's nice to be, I suppose, coming virtually on mornings like this. But we're going to talk about, I'm going to share at least my thoughts on a couple of issues. And we're going to talk a bit about fertilizer markets, and we're going to talk a bit about cash rent markets and try to explore some of the issues that are really impacting these particular markets and what we might expect for this year. One thing that we've been trying to do over the last few months is collecting fertilizer price data from points around Ohio. And here's a graph or a chart that we're seeing. And this table is sharing some of our recent information. So this is January collection data from retail points around Ohio on main fertilizer components that farmers are going to be buying. The prices are high, as everyone knows. We've seen this movement since, really going back to the fall of 20, as we started to see prices move higher, crop prices, we started to see fertilizer prices respond. And what we're seeing now are, in some cases, record prices, especially nominal prices. The first three, we're pointing out nitrogen prices, 28, urea, anhydrous ammonia, and then we have our primary phosphorus products at very high prices as well. And starter fertilizer, 1034, and potash. And what we've seen here, at least in the last couple of weeks, is a little bit of a slowing of the rate of increase. And in some cases, some of these prices, the graphs that we're looking at are starting to flatten out a little bit. And in some markets around Ohio and the Midwest, even urea, looking at that in some markets has seen a slight decrease. So, we're going to evaluate some of the fundamentals here in a moment. But I want to share this graph first. This is looking at corn prices, and this is from the Texas A&M study that was just released here within the last month and a half, looking at the corn price in red and comparing that over time, going back to 1995, and looking at the price of an adjusted anhydrous ammonia price. So you can see a pretty high correlation. As corn price goes, typically we're going to see fertilizer prices follow, and it is typically in that relationship. So this next one, I'll spend a little time talking about some of the fundamental drivers of fertilizer prices. The big one, we start out with demand, and whenever we're talking about something related to a market price and movement, we are going to be talking about supply and demand issues. So first of all, demand, the big mover and one of the big drivers of fertilizer prices has been crop prices. Crop prices being higher, margins have been strong, especially in 21, likely going to be a little bit less strong here in 22. But what we typically see is strong margins, strong demand. Fertilizer is not going to be something that producers will skimp on if they see strong margins. So we're typically going to see an uptick in demand, and we have globally. So this is driving these fertilizer prices along with a number of supply issues. And you can see that I've listed them out here, at least the way I see things playing out right now. In 2020, we did see a period where in the summer, we didn't expect to see high crop prices. A number of things occurred, including the derecho in Iowa, late season drought throughout parts of the Midwest, and then South America had some issues over the winter. And then Eastern Europe also had some weather problems, drove prices higher, crop prices, and that sort of caught the fertilizer sector flat-footed. They weren't expecting to need to ramp up production, and they've been playing catch up since then. So that, together with continued labor issues, created some more lengthier shutdowns on some of the fertilizer manufacturers globally and longer turnaround times. Those times that fertilizer plants need to shut down and perform maintenance, some of those have been extended over the last 18 months, which has created more supply shortages. Shipping issues, transportation issues, all those things, and largely related to COVID-related labor issues. And then we had a couple of real issues with the weather. February, that 21 freeze, and I know that storm had a name to it. It seems like we're naming all of our winter storms these days. But that February 21 freeze in Texas and parts of Oklahoma, that slowed up and in some cases brought to a halt natural gas production, which is a major component, the major component in manufacturing nitrogen and phosphorus fertilizers. So this added to more bottlenecks. Hurricane Ida, that disrupted shipping as well as disrupted nitrogen production in that Gulf region. High natural gas prices, in particular in Europe, has created some additional constraints on nitrogen production. China halting phosphate and UAN fertilizer exports, largely coming out of China. And they're primary, they're a major exporter of these products. Sanctions on Belarus for some of the issues related to immigrants being pushed into Poland. The EU and the US have levied sanctions on Belarus, and in turn, some of those potash shipments coming out of Belarus to the EU and the US have been limited. Recently, I just saw a news article yesterday that one of the primary, if not the primary, Belarusian potash exporters declared force majeure, indicating they weren't going to fulfill some of the contracts. Belarus is a primary potash exporter, and without that product, or with less product on the world market, that will only create more upward pressure on potash prices, in my opinion. Of course, what's going on in Ukraine and Russia, we can't ignore. Nothing directly that we see as far as impacting fertilizer prices at this point. But if there is some type of a geopolitical issue there and Russia does invade Ukraine, it could upset more shipments and marketplace, or the marketplace in that part of the world, which would then likely spread to other parts. So that we're going to continue to keep an eye on. If Ukraine is destabilized, they'll likely be less in the market for fertilizer, perhaps, and also less of a competition on exporting grain if they are destabilized, and it does affect their agriculture. Okay, then we switch over here to a couple of anti-dumping cases. Mosaic brought an petition for anti-dumping against two countries, Russia and Morocco. This has been resolved last year, so there are countervailing duties on phosphorus fertilizers coming out of those two countries. And the U.S. International Trade Commission, the Department of Commerce, they ruled in favor of Mosaic, indicating that there were unfair practices. And these countries were subsidizing phosphorus manufacture and export out of those countries into the U.S. So unfair trading practices. But that does create, perhaps, and it's hard to really sort out, higher phosphorus prices as a result of those countervailing duties. There's also a petition, an anti-dumping case being determined as we talk here. Over the next few months, we'll have some final determinations. The Department of Commerce, however, just recently ruled, they had a preliminary determination that UAN from Russia and Trinidad have been sold into the U.S. at less than fair market value. So, in other words, determining there was dumping going on into the U.S. from these two countries, and at different rates by different companies within those countries. So it looks very much like we're going to have countervailing duties, and there are already indications, or there already are cash deposits required from some of these companies out of these countries. So it's already limiting some shipments of nitrogen from these countries, and likely will have some impact on global prices, increasing those. It's really hard to determine how much. The Texas A&M study indicated that it could be as high as $100 a ton on certain fertilizer products. And then the last bit is looking further at industry consolidation. There's been a lot of discussion here in the last few months about whether or not it's all supply and demand related that are driving these fertilizer prices higher. And, whether or not there's a certain amount of these higher prices that's simply profit taking by those in the industry. If you look at the share prices for Mosaic, CF Industries, they were very strong throughout 21 and increased. That's not to say that that's profit taking is the only driver of these particular stock prices moving higher. Certainly, it's just a matter of at least a certain point. of these higher prices driven by supply and demand, it's difficult to sort out how much, if any, of that is profit taking. I know that I just read an article yesterday, someone in the seed sector, a CEO of one of the seed companies, indicating that they would be able to sort out supply and demand issues with higher prices, and then added a comment about and then some. So this was something that the USDA Secretary Vilsack found interesting, and it looks like they may start to examine a little closer some of the issues related to possible profit taking in the sector, possibly from both fertilizer and seed sectors. So I think it's interesting. It's something that we're going to continue to follow and try to make sure that we examine this and have a discussion on it as we go forward. As far as near term, I don't think there's much relief in sight as we go through the latter part of the winter and into the spring. I think we're going to have to see crop prices move a little bit lower and start to see some of these supply issues sort themselves out, especially on the labor side, before we start to see some relief. Okay, let me move on here and talk a bit. Well, I guess the last comment is this graph that I'll show, looking at the relationship between natural gas price and anhydrous ammonia, just illustrating this thought, or at least as we see it, the relationship between these two, the underlying cost, natural gas as it relates to the end product, anhydrous ammonia or nitrogen fertilizer in general. And you can see pre-2010, strong relationship, post-2010, not so much. And in some cases, almost an inverse correlation, if you will, between these two products, between these two products. So not cost driven anymore. It's primarily price driven. And we talk about commodity prices driving fertilizer prices. Okay, excuse me. Just a few comments on rents. Rents have moved higher in 21, and the expectation would be that they're going to move again higher in 22. This is a USDA NASS data. It's got an average cash rent per county. So this is some excellent data that can serve as benchmark information as landlords and tenant farmers evaluate and discuss rental changes. I know that their survey for 22 just went out here within the last week or two. I received one in the mail. So I think we're going to have another good set of information here for 22, and that will be published later this year. Our survey showed about a 3.5% to 4% increase across most of Western Ohio. And I do have other regions besides the ones that I'm going to show here, but these two regions, kind of this west central, southwest, however you want to define it, showing cash rental information and a bit of an uptick in 21. And that region, as well as this next one, this is Northwest Ohio, showing similar results. If you want these same tables for other regions of Ohio, we did recently do a webinar on farmland leasing update. That information is available on our farm office website, and you can actually go and review that recorded webinar, and all of those other regions are included on that. Some other data, the Federal Reserve Bank also showed a 4% increase year over year from 20 to 21. The Indiana statewide cash rental survey, also done similar to the way we do ours here at Ohio State, done by Purdue, showed about a 4 to 4.5% increase depending on the land quality. So it's useful information, I think, as we also look at Western Ohio. Number of factors that are going to drive rental rates, and we know what those factors have been up to this point. Net farm income has been strong the last 2 or 3 years, supported by significant government payments. And then last year, supported by higher crop prices. And the other thing, we continue to see net worth, this next to last point that I have pointed out here, owner equity net worth is still relatively strong, and I think that will continue to support land values and rents into 22. The one thing that will start to slow things down a bit is these higher input costs that will shrink margins. So I think these things all together will result in higher cash rents. It's just a matter of how much that we might see. And I would guess that it's going to be somewhere 5%, maybe slightly higher as we move into 22 here. So there's a number of things that we need to consider as we're looking and evaluating cash rents, whether you be a landowner, landlord, or a tenant farmer, understanding that these short-term high margin periods that we're experiencing don't last. And we have to have a cash rent in place that's long-term sustainable. So that's something that we have to consider. Landlords have to understand also the value of non-cash benefits. And if they do switch tenant farmers, some of those non-cash benefits don't always go along with that new tenant. Farmers should stress test their balance sheet, cash flow, make sure that they can go through the next 2 or 3 years at higher rents if they're willing to pay those. Cash rent bonuses might be a good alternative in this environment, as well as flex leases on a net income basis. Those may be something that people want to consider. That particular type of flex lease has a lot of moving parts, so we have to be careful on how we set those up. There's a lot of rent discovery methods. You know, the ones that I prefer, of course, is one-on-one negotiations. These other methods are options, but typically are not my first option as we look and want to work in a community long-term. Cash rent survey, or I'm sorry, the custom rate survey is out, and this is a way that you can help well, all of your neighbors throughout Ohio. We do this each year. This custom rate survey, the more data that we have, the stronger the summary and the results are. So if you're willing to help share your information, we'd gladly take all of that we can get in terms of how you're paying for or being paid for, performing different things across different types of experiences, whether it be harvesting or planting. And then the last but not least, the AgLink program is now open. This is from the Ohio Treasurer, and I've been asked to share some of this information. So the AgLink program will enable you to receive an interest rate reduction of up to 0.5% on operating loans of $150,000. So this is a valuable program for some, and it is now open. So just wanted to make sure that everyone was aware of that. And I'll finish up and turn it over to Diane. It's all yours. Thanks.
Thanks, Barry. So we're going to switch gears this morning to a financial standards update, which hope you all find this exciting as I do. But my really exciting opportunity this month is I get to join Barry and Peggy Hall in sharing grandchildren pictures. And my first grandchild, Tucker Ray, showed up on January 30th, and he and parents are doing well, and we're just tickled. But back to our topic for the day. Why do we look at financial standards? Why are they important? Well, there's really kind of two major functions that we want to accomplish with those. And first is to answer that question, what is the financial position of the business? And then the second, and equally important, is how is the farm business performing? And those financial standards are an exceptional tool to be able to do that. We are fortunate now to have the Farm Financial Standards Council in place. That has not always been the case. I think for most of us, it's been around for the better part of our career. But for those folks who are actually older than me and perhaps experienced some of those really challenging financial times in the 70s and 80s, where there was a lot of stress, some really good times and some really bad times. And when those bad times hit, one of the things that was discovered was we didn't have uniformity in how lending institutions, accountants, farmers were looking at and trying to evaluate the business portion of their farm operations. And so Bankers Association put a task force together, started working on this, and ultimately developed the Farm Financial Standards Council. And they put out 2 publications, this Financial Guidelines for Agriculture, as well as a book about some managerial accounting. And really important thing that they have accomplished is to bring consistency, uniformity, and integrity in financial analysis and reporting for agricultural producers. So it's not a static set of guidelines. And so we are going to see some changes. So that's what I want to share with you today. We currently have 21 financial standards, and our colleagues at the Center for Farm Financial Management at the University of Minnesota have put together a really nice piece that's very helpful for farmers. The Farm Finance Scorecard, it outlines the different standards and gives some benchmarks for those. And it also includes not only a description of each of those, but how they're calculated. And when you're working with farms or you're working with your own farm and one of those standards, maybe you're not achieving it at the level you want, the first question is, well, how do I change this? And it's not always simple, but that starting point is to go back and look at how is it calculated, because those are the factors that are impacting the calculation of that for your farm business. So we do have a link that we'll share with you for this particular tool, which is excellent. In the process of continually reviewing these standards, the first set that I remember was the Sweet 16. And then it changed and it was expanded, and there were 21 measures, which we're currently working with. But as we approach 2022, we're going to be working with what they're calling the Baker's Dozen. So we still have our main categories of analysis: liquidity, solvency, profitability, repayment capacity, and efficiency. But what you'll see is fewer measures underneath those. And really what they've kind of done is whittle them down mostly to 1 or up to 4, obviously. But in solvency, we had 3 different: debt to asset, equity to asset, and so forth. So there were more. Now they're saying, here are the ones we should be focusing on. But there are also a couple alternates that they've put in or kept in. And with liquidity, looking at working capital as a percent of operating expense is an alternative, but that Baker's Dozen includes working capital as a percent of gross receipts. And then under solvency, these other 2 measures are still certainly fine. It kind of boils down to what's your preference, what are you comfortable with? And then there's been a slight change on the repayment and replacement capacity to total debt finance and finance lease coverage ratio, where we had focused on term debt before, but that's still in that alternate ratios list. So the 2 we're going to take just a little more in-depth look at this morning is, what do we mean by debt coverage versus term debt coverage? And then the difference between these 2 ways of looking at working capital as a percent of gross revenues or as a percent of operating expenses. And you may have noticed that many of these slides are sourced from Pauline Van Nerden at the Center for Farm Financial Management, and she's graciously allowed us to share those with us. She also serves on that Farm Financial Standards Council. So as they updated us at the FinPAC leaders meeting, she had this really nice example of the little bit of difference we're going to see when we move from term debt coverage to total debt coverage. So the calculation for that, and that calculation is available for the term debt coverage on that scorecard worksheet we looked at first, starts with net farm income from operations, adds in any non-farm income, adds in depreciation, subtracts family living and income taxes paid, then adds back interest. So we're doing that so we're able to see how many dollars are in total are available to meet those either term debt or total debt obligations. So in term debt, if we were just looking at term debt, in this example, we have about 53,000 plus of interest that had already been paid on that term debt. But when we look at the total debt service for the business, which would also include operating notes, et cetera, it's a larger number. In this case, there were some other interest obligations. So the total dollars available for repayment is the sum of those items we just walked through, and then how much principal and interest was paid on term debt. That's the same, either way we're looking at this, but then we're adding the interest that was paid for current debt. So total dollars here for meeting those debt service obligations. So you can see when we're looking at term debt, we ended up with 3.6, which basically means there's $3.60 available for every dollar that is committed to paying that principal and interest on term debt. When we include that additional interest obligation, our margin goes down. So we'll be looking a little more accurately. I think we're looking at the bigger picture, not just the term debt, but the other interest obligations of the farm business. So there will be a little bit difference in what the standards are, but they also took a look at going back to 1996 all the way to 2020 in that FinBin national database, looked at what the term debt coverage ratio was, which is our orange solid line, and then the total debt coverage, if we did the total debt coverage ratio, how it would be different. And you can see that would be our dashed blue line, that it tracks very closely to the term debt coverage ratio, but there is a difference in times where perhaps interest rates were higher or farms had some more operating debt outstanding. So that is the first change we're going to see. The other is that the first recommendation that part of the Baker's dozen is going to be working capital and comparing that to gross revenues. So working capital, that difference between total current assets and total current liabilities. We hope that's a nice big positive number, but our step here is saying, is it big enough for the size of the business that we have? And so it's a different comparison there than comparing it to the total operating expenses, which is still an acceptable alternative measure if that's what you and your farm or clients are more comfortable with. But also they took a look at how those look differently from each other with the same farms. So our blue solid line on the bottom is working capital to gross revenues, and that's going to be our part of our Baker's dozen. And the top orange line is working capital to total expense. So since we hope total expense is a smaller number than our gross revenues, we expect that line to be higher, but you can see it tracks relatively closely, very similarly to working capital to gross revenues. The other change I wanted to share with you today is an update on how lease accounting is recommended to be handled. And they've been working on this for a while, but even started back in 2016, started looking at what some potential changes might be, and they're looking at integrating these into the work starting in this year, 2022. So we're considering two types of leases: financing leases and operating leases. So the finance lease is that basically it's an installment purchase. We previously referred to those as capital leases, where we pretty much expect that the farm will ultimately end up with that asset. And things aren't going to change very much in terms of how we report and handle those, but we'll see more differences here in the operating leases. And these are leases with terms that are greater than 1 year, but these had not been reported on the balance sheet. Typically, the farm typically wasn't expecting to retain the ownership of that asset or buy it out, however that was written up in the lease paperwork. So how are these going to be a little bit different? This operating lease accounting is where we're going to see a change. Now it's going to be put on the balance sheet and termed a right of use asset. And you got to dust off the financial calculator, because how are we going to value that on the balance sheet? It's going to be the present value of future lease payments. And then the liability associated with that operating lease will be the dollars, the lease liability for that particular transaction. So a nice table here from Pauline Van Nerden summarizing these with the finance. You know, how do we differentiate those? Has control of the asset passed to the lessee? In a finance lease, it has. In the operating lease, it has not. They will now both appear on the balance sheet as a right of use asset and termed as a lease liability. Well, so the asset will be the right of use asset, and then there will be a lease liability balancing that out. Income statement, the finance lease, only the interest expense shows up on the interest statement, and the amortization portion of that lease payment will show up basically where we would put a principal payment. So not on the income statement. The operating lease will continue to show up on the income statement as a lease expense. Cash flow statement, very similar. The cash paid for the interest will be an operating expense. The cash paid for principal will be considered one of the financing portions. And the operating will show up as cash paid for the lease payments in that income generated from operations section. So just want to note as we wrap this up that land leases are different. Even though you might have a written lease for multiple years, they don't show up on the balance sheet, and you will continue to report them like an operating lease on the income statement. And typically we have that line itemed as land rent or land lease payment. So the Farm Financial Standards Council has a website. You can go there, find out more about that council, but they also have for sale their publications with a lot more detail than we went into today. They are very helpful. So if you really enjoy farm financial stuff, I would not have put you to sleep like this lovely grandbaby. But for those of you who are not so excited about this, now it's time to wake up. And Jeff Lewis, I'm going to hand it off to you to share about Farm Office.
All right, thank you. So this is our Farm Office website, and the URL is pretty simple. It is farmoffice.osu.edu. And for example, today I put in the chat box for you to download the slides for Farm Office Live. And there are two ways you can get to the Farm Office Live page. Either one under events here, the Farm Office Live, and you will see some information, registration link, and then today's slides in that farm finance scorecard that I put in there in the chat. And then below you will see the previously recorded sessions of Farm Office Live. There's another way to get there, and it's by one of these big picture boxes right here. And right here at the end, you'll see the Farm Office Live page for you. Some other things that we mention frequently on Farm Office Live is the Ohio Ag Law blog. And you can access the Ohio Ag Law blog from this link up here on the menu bar or down here in this picture box. And the Ohio Ag Law blog, please excuse the mess. I think this is a Mac issue, but you should see articles here. Mine are all the way at the bottom here. And you can click into the specific blog post that you want to read, and it'll bring up, just that blog post, so you don't have a whole list of posts to look at. And you can go over here to this archive right here and click on any month to see a bunch of blog posts from the past. In addition to the Ohio Ag Law blog, we have the Ohio Ag Law Law Library. And you can access that again here, and you don't even have to click in. You can see the different categories we have here. Or if you go to the webpage for the Law Library, you have the different categories that you can click into and find specific laws and publications related to that specific category. We go back to our Farm Office homepage. At the bottom here, you will see different news items that we try to post frequently in our upcoming events. As you can see, Peggy, Robert, and David have a Planning for the Future of Your Farm webinar series on the 21st. And you'll see more recent blog posts over here. And this stuff will be changing as we, kind of modernize and get with the time. So hopefully you'll see some of our social media accounts and our posts that we have on there. The farm management, you can head over to the farm management link and look at these different tools. Chris is going to specifically be talking about the Farm Bill decision tool. You just click in there and you can download all those different decision aids for you. And then you have the tax link up here as well in the menu bar, where as we get later into the year and the tax schools start to pop up, you'll see a lot more information about that. And then over here, we have the Ohio Ag Manager blog, where David and others post about different farm management and ag manager issues and resources for you. So that is, in short, the Farm Office website for you.
You were getting ready to say Ohio Ag Manager again, but they all work together. So we thought it was great to have Jeff come on and to kind of show you the layout of the Farm Office website. The redesign has been really, really cool. So now we'll transition into pandemic relief programs. I have a quick update, and is usually when we're here, we say, well, something was announced. And yet again, here in February, there was a new program that was announced, and that was the pandemic. I guess it's not new, it's in the second year, the Pandemic Cover Crop Program. So there's another acronym for you, PCCP. Again, that was offered in 2021. It's helping producers who have crop insurance to receive a premium for their crop insurance for planting those cover crops. So last year was $59.5 million in premium subsidies was awarded for 12.2 million acres. Again, this was just announced for a second year, was announced last week, February 10th, that the program is out there for this year. And note here is that the sign up for this program needs to be done by March 15th, 2022. So this is going to provide a premium support up to $5 per acre. If your premium's less than that, but it is up to $5 per acre. That's the maximum. So those that are insuring their crop, spring crop with insurance policies, and then planted a qualifying cover crop. So that cover crop would have been planted anywhere from June 15th of last year through the fall. So you'll receive a benefit only if you file this report of acreage form. That's an FSA form. So this is an RMA program, but you're filing the report of acreage through the Farm Service Agency office using the FSA 578 form. Most of our producers will be well aware of this form because this is the form that we do our annual reporting. And this deadline for the cover crops is March 15th to get this premium benefit. Just understand the other crops that you traditionally report will be in that same timeline. So for many of us, that's in the middle of July. So as you look on the report of acreage, you're going to have to know the cover crop type, the number of acres that the cover crop has been planted on, a map with the approximate boundaries for this planting, as well as when you planted it and the planting pattern. And if there's irrigation practices, you would report those as well. Of course, you can find more information about this at farmers.gov. Any of the pandemic assistance programs have been talked about there at farmers.gov. And then you can see the longer link there with the cover crops and some of the frequently asked questions. So for producers who have crop insurance and planted cover crops, great program to enroll in. But again, enroll by March 15th. Moving on, we have talked about these in previous Farm Office Lives. Just as a reminder, the Spot Market Hog Pandemic Program, SMHPP, that was announced in December for those hogs. So this is going back to the early days of the pandemic of 4/16/2020 through September of 2020. You're eligible for some additional assistance there. Eligible for hogs up to 10,000 heads at $54 per head. So you have until February 25th. Less than 9 days here to get your applications in if you haven't already done that for the SMHPP program. And then just a reminder, this is a program that was authorized in the 2018 Farm Bill. This is the Livestock Indemnity Program. So it provides any benefits to producers that have livestock deaths in excess of normal mortality. So this could be caused by adverse weather or even attacks by animals that were reintroduced into the wild by the federal government. Know that that program pays up to 75% of the average fair market value of the livestock. The USDA has an excellent handout on that. And I provided the link there for you today that you could go, and I believe it's a 6-page document that you can read through, which includes what the value, the 75% of the average fair market value would be. Just know if you're in this situation where you've had some adverse deaths, loss of livestock, reporting deadline is here at the end of the month, there on March 1st. And then Diane's favorite program, the Dairy Margin Coverage Program. We've talked about this a couple times in our Ohio State Dairy team. And I think Jeff will maybe put the link in there, or Diane will put the link. Had a wonderful webinar this month on these programs, the supplemental DMC coverage program, as well as the Dairy Margin Coverage Program. Just know that that has been extended through March 25th. They had extended to February 18th. It has been extended to March 25th. So for our dairy folks, or if you have clientele that are dairy folks, encourage them to check into the Dairy Margin Coverage Program. And this is just a summary slide of those deadlines, upcoming deadlines that we mentioned. You'll notice I also put on there the Conservation Reserve CRP program sign up that started on January 31st. And that's going to roll through March 11th. And I think for most of our corn and soybean wheat producers here in the state of Ohio, the biggest program sign up that is looming for them is this agricultural risk coverage and the price loss coverage, the ARC and the PLC program coverage. That sign up has been open since October, but it closes here on March 15th to make your elections. And that's is why we have invited Chris Brunis to come on board to give us an update on the ARC PLC coverage program today. Chris has been for years doing teaching in this area with ARC and PLC. So just a perfect time to have him come aboard and be a guest. And Chris, we should say, like Barry, like Peggy, like Diane, you have a little grandchild on its way, and you're going to head out here and hopefully get to meet the newest grandchild here, even hopefully by the end of today. So
Later
Chris,
today, early tomorrow.
I'm going to turn it over to you, and welcome to the Farm Office Live program.
Is my screen sharing, David?
Yes, it looks great. Yep,
Okay,
you can
because I
flip
got
to
an
your-
error message that didn't make sense to me, so I thought better check. So,
Yep, you're looking
well, hey,
good.
it's good to be here. It's good to be here to get right into this. Let's talk about the Farm Bill. Well, some reminders. As everybody's been talking, this March 15th seemed to be a pretty popular day for most deadlines, whether it's enrollment for CRP or for ARC County PLC or enrollment for crop insurance. That March 15th seems to be a popular deadline. Just a reminder that we need to do this as well. And then every year we have the choice of an enrollment and an election. And the election is which program do we want to be in? And if we don't make any changes by March 15th, then whatever program we were in last year is our election for this year with no penalty. If we go back to the first year that we had to elect a program, there was a penalty. If we didn't do that, we were still in the program from last year with a penalty. Now there's no penalty. And we also need to go and enroll. I know there was multiple year enrollments. You know, if you did any kind of changing on that farm, I know that on our farm, I sold off a little piece of land and now I had to go back in and re-enroll because last year's enrollment wasn't accurate anymore. So check with your FSA office to make sure you're enrolled in the program of choice. And then I checked with my FSA office, and effective February 14th, beginning of this week, they're all open for business. They are not allowing walk-in appointments, even though their doors are now unlocked. They do require appointments to be made. They're trying to minimize the crowd gathering at the counter. And they also will still schedule virtual appointments. So if working with them virtually is easiest for you, they're still willing to do that. What we're looking at right now is electing a federal commodity program, and just a little bit of history. we have basically three choices. The Agricultural Risk Coverage County, which is a county-wide revenue protection type program. It's paid on 85% of the base acres on the farm. And no, there isn't any opportunity to update the number of base acres on our farm with this current farm bill, but we can get paid on 85% of those base acres with a county yield and county revenue guarantee. Agricultural risk coverage and individual policy, it's reduced to only 65% of the acres. But what's enticing about that is if I have a farm that doesn't follow along with the county averages, and I plant it all to one commodity, all of those base acres on that farm become base acres for that commodity. And so if I plant the whole thing to corn, I now get all of my base acres are corn base acres instead of what they were traditionally earned in. And then the last one is a price loss coverage. Most of you remember this. It's been around now for a while, and it just has a straight price that if the price falls below that, you get a payment, again, paid on 85% of the base acres. And then if we want to use the supplemental coverage option, I'll come back to that. That insurance policy can only be used with price loss. And so again, March 15th is the deadline. And we can make this election. If we go back a farm bill or two, we had to do our whole farm the same way. We can do this by FSA farm number level. And so each farm that we farm, we can make a different election. And I know some strategies have been, I'm going to put some in each program. That way I spread out my risk in terms of if one program pays, I'll at least get something. We'll look at that a little bit more going forward if that's advisable for 2022. So just a refresher, here's PLC. And we look at that historical 2014 to 2020 performance. And this is an example for Hardin County here in Ohio. And again, that $3.70 is kind of that baseline price. And if we fall below that, we get a payment. And so again, we remember the very, very high prices we had in 2010, 11, and 12. They started to come back down. 14 was back down in that 370 range. And again, this is a market year average price. So this doesn't mean what did I sell my corn crop for or my soybean crop for. This is what was that average price that crops were sold for between the end of or the beginning of harvest. So for 2022, it will start September of 2022 and go through the end of August in 2023 for corn and soybeans. And that's going to set our market year average price. So if I had to ask you today, would you bet the farm on what the price will be a year from now? I doubt if many of us would want to do that. And so again, this isn't today's prices. This is what it's going to be in the future. So dust off your crystal balls and try to figure out what that's going to be. The other one that I want to put up here, the program refresher, historical for Ark County, again, Hardin County example. And so when we start looking those actual revenues against the guarantee, that black line is the guarantee that started in 2014. And when our guarantee was above our actual revenue, this is county yield times that market average price, we would get a payment. So 14, 15 was our biggest payment, a little bit in 16. But as you noticed, as we incorporate those lower prices on that 5-year Olympic average into that revenue guarantee, it starts coming down. And so 2018, 19 was very minimal payment in Hardin County. Many counties did not see a payment in 2019. And then 2020, at this point, we don't have the, we have that price, but 2021, we don't have the market year average price done yet. But in 2020, again, there was no payment on any of our farm programs. And so come back to Ark individual. Again, we go back to 2019. We knew that we had preventative plant acres. We could make that decision. It was middle of the summer before we made that decision. And so we could run the computer models and we knew that it was going to be the best choice for those preventative plant acres. when else do we think that this is going to be something to look at for our farms? And I have a farmer that has a farm that's basically on top of a gravel pit right across the road. There is a huge gravel pit, and that vein of bedrock follows under that road and into this field. And in 2020, he harvested 70 bushel corn, which was way below the county average. And he had that in ARC individual and collected a significant payment on that farm. And so that would be another one. If our farm yields are 15%, the historical 5-year average for that farm, the problem is we don't know what year that's going to be. But if we have one of those farms that every so once in a while we have that poor yield due to weather conditions and it doesn't follow the county, then ARC individual might be a program you want to look at. The other example is those high year-to-year productivity variability, similar to the one just that we talked about, but this would be a river bottom, something that's kind of feast or famine. If the waters rise and floods out that field and we don't get a crop, then we're probably wanting to be in ARC IC. Now the caveat is, if I have a little bit of bottom ground and the rest of the farm is not, will there be enough water to affect that? And that's always a challenge to try to figure that out. And the fourth example is large acreages of fruits and vegetables is something that we may want to look at, because fruits and vegetables tend to have more variability in yield than corn and soybeans and wheat. So what's going to happen? That's probably my most favorite question I get from my farmers in Ross County. Tell me what to do. Well, that's really a hard thing to do. We can look at probabilities, and a colleague of ours, Ben Brown out in Missouri, used to be here in Ohio, has looked at probabilities of what do we think is going to happen. But again, nobody really knows. We can just say this is our best guess. And so looking ahead, again, the Hardin County example, 2021, again, that's an estimate. We don't have our market year average in yet, but we know yields were tremendous last year for most of the state. And then 2022, again, looking at average yields, we have no reason to believe it won't be anything but average. And again, what we're looking at, what that price may be being projected, we think we're going to be well above an ARC County payment. And then if we go to the right-hand side of the slide, the same thing looking at PLC. Again, our prices, he has 476, and this was done a month ago. And what's happened in the markets since then, that may be a low estimate, but that was the estimate at the time. Even if that comes to fruition, that's still $1 above our 370 reference price for PLC. So looking at those two, and I think you can take the same scenario looking at ARC individual. Again, there's no prediction that anything is going to make a payment for 2022. But I think that's a good thing. I know most of us would rather have the market pay us than the government pay us. And so, I think that's a good thing that there's no projected payments. But what are you afraid of? These potential black swan factors for 2022, Barry mentioned a few of them in his presentation already. We always have weather risk. Go back 6 months, nobody was predicting drought for Brazil. And now they're having some drier weather and it's affecting prices. It can go the other way. Nobody's banking on a drought for the U.S. Corn Belt, but it could happen. What about geopolitical relations? What's happening in Russia and Ukraine, China and Taiwan, our phase 1 deal with China. Again, what's going to happen going forward? Anybody's guess. Those of you that are old enough, and I remember when Carter had the Russian embargo and we went down limit 3 days in a row on soybeans. And so, what's going to happen? We have no idea. Supply chain issues, again, Barry's already spoke about those. Again, Jeff will probably drop this in the chat, but the Farm Decision Tool Aid is out there. If you want to go in and play what if, I did some what if analysis for my farmers in Ross County. And basically, if prices stay at our projected level for Ark County to make a payment, we would have to have about a 35 to 40% yield loss. Nobody's banking on that. But again, if you want to look for your own county, that tool is there, and do take advantage of that. I want to shift gears just for a few minutes and talk about crop insurance options, because I think crop insurance and farm bill decisions go hand in hand, and we need to think about both of them at the same time. So they're not independent decisions in my mind. And so we look at the three buckets of risk. Commodity programs is one. We already talked about those programs. We have our basic underlying policies in the second bucket. And then we have those supplemental and enhanced coverage options, margin protection, kind of in that third bucket that we can choose from. And depending on how much risk we want to assume, commodity programs, Ark County, Ark individual, and price loss coverage doesn't cost us anything to enroll. And so we should sign up for those. It does put a bottom, even though we may argue that that floor of risk, or that floor of guaranteed revenue, is too low in today's environment. And so then we can look at the underlying policies, and let's just look at that. We expect them to be up this year. This comes from my crop insurance agent. And at the time when he put this together 10 days, 2 weeks ago, the corn price was projected at $4.85. Like I said, these might have creeped up a little. I mean, that was last year. 2021 was $4.85. This year was projected at $5.73. So that's a 25% increase. Soybeans, a 15% increase. And so is crop insurance going to adjust at the same rate? And the volatility factor is down from a year ago. And so our corn premiums was estimated at this time was going to be up about 8%, and soybean premiums about 3%. And so those under that second bucket, revenue protection, we know what these are. I don't need to spend time going through those. This wasn't intended to be a lesson in crop insurance, but just be an awareness that we have these tools available to us, and we may need to look at these to bring that revenue guarantee up to a point that's acceptable for our farm business. Crop insurance options, supplemental crop insurance, as I mentioned earlier, it goes from your revenue protection product up to 86%. So if you buy an 80% coverage, this is another 6%. But this isn't protecting your farm. This is protecting the county average. So it's very similar to Ark County. It's a county average product, or it's a county yield product. Again, time fall price, where Ark County is times the market year average price. I'll mention that again on my conclusion slide. The enhanced coverage option can go with any Farm Bill program decision. So it can go with Ark County, because Ark County covers up to 86%. So this is above, and it's not covering the same coverage spot that SCO does. So this one could be paired with any. It's quite pricey, but again, depending on your risk level that you can assume, is it something that fits for your business? And let's take a look at that. Here's an example. This is on my farm in Claremont County. So the county average is 186. My farm's average is 200 bushels per acre on corn. This is a corn example. And so we've put in 550 as an estimated price. And then we start looking at the different coverage levels. Well, that underlying policy, that revenue protection at 80%, is going to cover $880 of expected income or expected revenue. And so we know we'll get that much. That's going to cost $31.91 per acre. And then if we want to buy that additional 6%, $8, that's going to add an additional $66. But again, that's not on my farm. That's on the county, where the revenue protection is on my farm. So on my farm, I'm covering 80% of the 200 bushel per acre times the price, where on the SCO, I'm covering 80 to 86% of the 186 bushel per acre times the price. So it's a different yield that we're protecting. And then if we want to go to the ECO, again, that is a county yield revenue protection, not to my particular farm. And so the risk of that is if my farm does very, very poorly and the rest of the county does well, I may not get a payment through those products. Conversely, if my farm does really, really well and the county does terrible, I might get a payment where I really didn't need one. Of course, we'll always take our premiums back, right? And so in summary, just a few concluding comments here. Don't forget to make that election if you want to change. Again, I'm going to let crop insurance drive that decision for me this year. It doesn't appear that any of the programs are going to make a significant payment, if any payment at all. And so depending on what crop insurance options I want, I'll let that drive my program election for the Farm Bill programs. Don't forget to enroll March 15th. Also, your crop insurance deadline, March 15th. So looking forward, already mentioned, prices are not likely to fall below effective reference prices. Our county, because we think that a yield loss might be a higher probability than a price loss. And if we start seeing yield losses, what typically happens with prices go up. So we're seeing yield losses in South America right now. Soybean prices have increased. And so, we think that if we have anything, it might be a yield loss. Ark County has a probability trigger, but now if you want to use SCO, since SCO covers very similar risk that Ark County does, again, different price, market year average compared to season price. PLC with SCO might be the most complete risk coverage, but if you're doing an 85% RP product, that 1% that SCO gives you probably isn't worth it. And then I would look at Ark County. Play with the Excel tool to see what's happening. With that, Peggy, I'm going to pass this off to you, and I'm going to start driving to North Carolina, and hopefully the grandbaby gets there before I do.
Thank you so much, Chris, and safe travels, and we hope all goes well with that grandchild. Congratulations are in order. Okay, so we're going to make a switch now, and good morning, everyone. We have a couple of legislative updates for you, first on the state side, and then we'll talk a little bit about the federal side. As we look here at the map room, if any of you have ever been to the State House or haven't been, I would encourage you to see the map room there. One of the most photographed rooms in the State House, and has a map, of course, of the state of Ohio in every county. There are 8 different kinds, I think it's 8 different kinds of marble in that floor there. So it's a beautiful thing to see. We have the second session of the Ohio General Assembly, their 134th session, the second year beginning here, January 1st. So that means that any legislation that doesn't survive and pass by the end of the year will die. And we start over again in 2023 with a new session. So we're hoping that some of the things we've been monitoring will get through here before the end of the year, and we won't be back to ground zero and having to try again with some of those important pieces of legislation that we need in ag. One that I think may surprise some of you that I've reported on before, more so kind of out of a joke, because this is something that I see come up every session, this intent to repeal the state income tax. And there's good reason for it. Ohio feels that, it's at a competitive disadvantage by having a state income tax compared to other states that do not. And so this comes up over and over again. But this time we now have 2 resolutions. I told you the last time about the House resolution or the Senate resolution that was introduced in December. We now have a companion House resolution that was introduced in January and has already gone to a hearing before the Ways and Means Committee. And you can see the very simple language down there at the end of the resolution that says that simply they want to express an intent to repeal that personal income tax within 10 years. So sending a strong message that some changes need to be made in order for that to happen. There was a good amount of discussion on this at the committee hearing, so it'll be interesting to see if it really does go somewhere this time. We also had another proposal on income taxes. House Bill 515 is the companion to Senate Bill 247, which I have reported before on Farm Office Live about. That one has gone all the way to its third hearing in the Senate Ways and Means Committee, but seems to be stuck there. On the House side, though, House Bill 515 was introduced December 15th and has already had 2 hearings before the House Ways and Means Committee. So this is one that affects the treatment of the sale of an ownership interest in a business. And it aligns Ohio law with federal law. And so that the sale of that ownership interest would be considered business income if the federal income tax law treats it as such, and the seller materially participates in the business activities during that taxable year that the interest was sold, or any of the 5 preceding years. So that one seems to be moving. It's part of a couple of bills, though, that I think could get caught up for a bit. Some other legislation that's on the move. We have that poultry chick legislation that I told you about previously, perhaps the simplest bill that we'll review for you ever, because it changes one word in the Ohio Revised Code, changing the minimum lot size for sales of poultry chicks from 6 to 3. And I learned that the purpose for that bill is to address the concern that many of our 4-Hers who especially are selling turkeys have to buy 6 turkeys and then find somewhere to have the 5 that they don't sell or show processed. And because we have some processing difficulties, that has been a problem. And so Representative Kaler has brought this bill forward, and it's had its first hearing before the House Ag and Conservation Committee, which he also chairs. So I expect that one will go through and address some of those problems our 4-Hers are having. The Safe Drinking Water Act bill, House Bill 365, was introduced quite a while ago, but is finally now getting its first hearing before the House Ag and Conservation Committee. And that was just this week. There was a lot of activity this week and then some last week as well in the House Ag and Conservation Committee and the House generally. They're really getting back to work now after the holidays. This one would address PFAS, those forever chemicals that you've heard about. And those have been problematic for some of our livestock operations, withdrawing groundwater, having some PFAS issues. So this would establish a requirement for the EPA to create water quality standards and maximum contaminant levels for PFAS chemicals, as well as 2 others, chromium-6 and 1,4-dioxane. Pretty technical bill directing the EPA to start taking a look at these and trying to create standards. And so we'll see if that one goes beyond its first hearing. Also over in the House, I've told you about this one before. This is one of those fun bills that we see every now and then. It would designate the Lake Erie walleye as our state fish. I learned that Ohio is one of only 3 states that does not have a designated state fish. And so, of course, we have to get in there and keep up with our neighbors. So this would designate the walleye, and that is the fish that won an online poll, by the way. That's how they chose the walleye. It captured 27.5% of the vote, beating out yellow perch and smallmouth bass. So that one had its first hearing before the House Ag and Conservation Committee this week also. The slow moving vehicles bill that passed the House back earlier in the summer, June 23rd of 2021, has finally received its 3rd hearing. It has been slowly making its way through the Senate Transportation Committee, and it saw the same fits and starts over on the House side, but it had a 3rd hearing February 15th, and this would address some of the safety concerns affiliated with our horse-drawn vehicles in Ohio and would improve their lighting and marking requirements for visibility purposes. And it appears that our Amish and Mennonite communities are supportive of this bill as a safety measure. So that one's moving. And then we have House Bill 397, the statutory termination date for agricultural leases. This one just had its second hearing on the Senate side, has already passed the House. So had a proponent testimony on February 15th earlier this week. It would create a statutory termination date requirement for any lease that doesn't address termination and notice of termination. And what that law would say is that a landowner who wants to terminate a lease, a farm lease for crops, this is crop purposes only, and if that landowner wants to terminate that lease and doesn't have a provision in the written lease or otherwise, i.e. a verbal lease, then the landowner would have to terminate by September 1st of that current lease year. So would have to give a written notice of termination by September 1st if the lease is not going to be continuing over into the next year. So that will certainly affect many of our landowners, and we will let you know if that one makes it through the Senate. The auctioneers bill that I've told you about before as well, House Bill 321 that passed in December on the House side, has now gone to the Senate Ag and Natural Resources Committee, and they had their second hearing this week on that bill that would change a lot of the licensing requirements for auctioneers and remove that apprenticeship requirement. It would also allow ODA to have authority over internet auctions, which surprisingly are now currently exempt from that kind of oversight. So that one appears to be moving. And then we have, Barry mentioned the Ag Link deposit program, loan program that is available through the state treasurer. The legislation that would change that has passed the Senate. They're just agreeing now on when it will be effective. The two sides have passed the same provisions, which would expand those loans to ag cooperatives and remove that $150,000 limit that Barry showed you is currently in place. That limit would be removed, and the treasurer would have the discretion to determine the maximum loan amounts on a case-by-case basis. So that is still right at the end of the process, could become effective immediately here if there's agreement on that provision of making it immediately effective, so that loans currently taken out would be subject to these new provisions. And then finally, we have the post-nuptial agreements bill that I've also reported on before. It passed back in November in the Senate and is now before the House Civil Justice Committee. And that would allow spouses to revise their prenuptial agreements, i.e. to make post-nuptial agreements. It would also cover separation agreements, allow those to be revised. Right now, Ohio is, again, one of few states that does not allow this. And so there would be modification of those kinds of agreements between spouses would be permitted under this provision. So that one's moving. And I think that finishes up the state side. I'm not seeing any questions. So let's move on to federal legislation. This one's a little bit, I guess, trickier to report because there's not a lot going on the ag side, but tricky to keep up with the other bills that you've heard me talk about that I think are kind of consuming our Congress to a large extent. And so we're not seeing as much activity on some of the ag issues that so some of you who've been on previous versions of Farm Office Live have seen this chart that I've created. It's a little bit painful to work through, but I think it shows you just how consuming the work has been down there in Congress, just keeping up with these issues of government funding, the federal debt limit, infrastructure, and the Build Back Better proposals. Those were taking up a lot of time the second half of 2021. And now we're seeing still that some of these are not moving along so that we can move forward into some other issues. The most recent development is just yesterday, the Senate agreed with the House to kick the funding can down the road a little bit further. They extended now short-term funding, government funding to March 11th. So a couple more weeks, 3 more weeks of funding provided. Their intent was to have a full year appropriations bill in place by today, but instead, apparently a lot still under discussion. They're not ready for that. And so we got another 3 weeks of government funding. Again, this is a distraction to some of the other things that need to happen. And then we have, the federal debt limit continues to be a concern among several key senators, especially Joe Manchin, who has been falling back on that as a way to suggest that he just will not agree to Build Back Better because it puts us way beyond where he's comfortable for the federal debt limit. And I was sharing with the Farm Office team that Joe Manchin he has a staffer who every morning updates him on the current national debt number. So many say that he is kind of obsessed with the national debt. So we may still see some activity there. The infrastructure bill is safe and done. Nothing we have to worry about there, but we're very much in the implementation phase. And so we hear a little bit there, both good and bad, on how that bill is being implemented. But that takes us to Build Back Better. And I've invited, let's see, is Robert on here? Robert, are you with me?
I'm here. Yep.
Okay, I can't see you on my grid. I've invited Robert. As many of you know, Robert just joined our program at OSU. I'm very happy about that. We've worked together a long time, and I'm just very excited about the expertise that he brings to our program and to the Farm Office team. And one of them is tax and tax implications for ag businesses and landowners. So Robert, what do you think about Build Back Better, which is always so hard to say?
Right.
What do you think? Where's it going?
Well, first, I would say I can't think of a worse way to start your day than being updated on the federal debt. So I don't know what that says about Senator Manchin, but it says something. Build Back Better, I'm now calling it Build Back Never. I just don't think it's ever going to happen in its current form. It's dead until the Democrats can hold the House and increase the number of seats they have in the Senate by at least 2. And that seems pretty unlikely to do both and maybe either. So in its current form, I do think it's just not going to pass.
And you're not alone, by the way, in wanting to rename it. I've heard, as I read up on this constantly, I've heard so many people make jokes about the name and how it just needs a new name. This is not the right approach. But so what I'm hearing, though, is that it could be kind of chopped up into smaller bills that address parts that are favorable. And the concern that we've had in the ag community are the parts, especially the tax parts, that could be unfavorable. Probably the most concerning being the step up in basis. Do you think that one's dead?
So there could be parts of Build Back Never that could still happen. They could kind of cleave off some of the provisions of it and pass those as separate bills or separate legislation. The big impacts that we're going to affect the farming community, those don't seem to be in play at this point. I've not seen where lowering the federal estate tax limit is being discussed. It looks like the stepped up tax basis is safe, which is a huge deal for farmers and small business owners. It does look like Senator Manchin wants to increase some of the corporate tax rates. So that could be in play, but then Senator Sinema in Arizona says no way. So I'm not even sure if that will happen. So it could be, what does get passed probably is going to be pretty narrow, probably pretty limited. And I think agriculture is going to largely escape many adverse effects from that.
Yeah, and it does feel as though Joe Manchin has a lot of power right now on this, and as you said, Kristen Sinema right behind him. And so I did a little research to see where Joe is these days, or Senator Manchin. I shouldn't call him Joe as if I know him personally, but where Senator Manchin is, and he's sent that clear message that he wants to address this federal debt limit, the federal deficit issue. But people keep saying, well, then propose something. He throws out what he likes, but we haven't seen any actual proposal from him. But as he throws these pieces out, it sounds as though there are groups putting packages together. So looking at what he has expressed, and again, it's not all up to him, but many are paying attention to what he says. Climate change, yes. Interest in that. Clean energy as well, although he always maintains that we do need to continue to address, of course, coal, an issue for his state of West Virginia. But then his tax policies don't look too bad, do they, for ag, Robert?
No, as far as farms, there's not that many farms that are taxed as corporations, and those farms tend to do a pretty good job of managing their income, and they're not, significant increases in tax. So even if there are tax increases, again, I think it's going to have, pretty moderate effects on the farming community. Some larger agribusinesses will definitely be impacted, but just at the farm level, I think, again, effects are moderate at best.
Good. So we'll keep an eye on all of this and see what happens next as we continue to just slowly and painfully work through some of these big issues in Congress. While some of our ag issues are put on hold during that process, both the House and Senate very much still in the hearing phase of their new sessions. But one thing that has happened is the Ocean Shipping Reform Act that I've previously reported on that would address some of those supply chain issues, some of the frustrations that we've seen with international shipping practices. It did pass over in the House and has been introduced in the Senate earlier this month by a bipartisan team, Senator Thune and Klobuchar. And that is one that we do keep hearing about consistently. So it doesn't seem to be just falling into the great black hole of legislation that we often see in Congress. So that one appears to be moving and could yet pass here soon. And then I've told you about these 4 bills that were reported out of the House and sent over to the Senate for ag bills. But there has been absolutely no activity at all on these over on the Senate side. So those are still sitting there. The Forest Restoration and Remediation Act, the Chronic Wasting Disease Act that would provide more funding and research on that issue. The transparency of our cattle contracts through that Cattle Contract Library Act, and the extension of our livestock mandatory reporting. Those are all still just on hold. So not a whole lot of new federal activity to report for you. And I just want to close out by sharing this. This was presented this week from our National Association of State Departments of Agriculture. they have released their list of Farm Bill priorities. And that's always a signal that we are starting to gear up for the 2023 Farm Bill hearings when we see groups and associations like this release their priorities for the Farm Bill. So we'll probably be reporting more and more on Farm Bill as we continue Farm Office Live, David. Back to you.
Great. I appreciate you, Peggy, being and Robert, both for your insight on. Seems like I'm super stoked about the whole walleye bill to make sure the walleye is the fish of Ohio. But I would like to thank everybody and wish everyone the best. And just a reminder that on March 16th and 18th, we'll be back again here for the next Farm Office Live in the evening of March 16th and Friday again on the 18th at 10 a.m. to 11:30 p.m. We hope everyone stays safe in this weather. And just a reminder, as you exit the webinar today, you're going to get a quick evaluation, and we sure appreciate your response to that. So with that, the little driving music for you today.